2 ETFs, 1 portfolio, $6,000 every single month. Without clocking in, without a boss, without selling a single hour of your life to get it. That sounds like something you'd see on a late-night infomercial. But the math is real, the funds are real, and by the end of this video, you're going to know exactly what it takes to build it. The portfolio size, the timeline, the tax strategy, and the order of operations that most people get completely wrong. Here's the stat that should make you uncomfortable. As of 2025, 67% of Americans are living paycheck to paycheck. That includes people earning six figures. In fact, 20.6% of households bringing home $150,000 a year or more are still stuck in that cycle. The problem isn't the paycheck. The problem is that a paycheck stops the second you stop showing up. What we're building today is income that doesn't stop. Income that hits your account whether you're awake or asleep, traveling or sick, working or retired. $6,000 a month is $72,000 a year. That is almost exactly the median U.S. household income. So what we're building here isn't a supplement, it's a full replacement, and you're going to do it with 2 ETFs. The two funds are JEPI and SHD. That's it. No individual stock picking, no options trading, no crypto speculation. 2 tickers. Let's get into why these two specifically, how they work together, and exactly how much money you need to hit the target. SHD, that's the Schwab US Dividend Equity ETF, is the foundation. It holds 100 stocks, all filtered through a strict screen for dividend consistency, dividend growth, and overall financial strength. We're talking companies like Lockheed Martin, Verizon, Coca-Cola, Home Depot. These aren't startups. These are businesses that have been paying and growing dividends through recessions, market crashes, and pandemics. Right now, SHD yields about 3.36%. That's not a jaw-dropping number on its own. But here's what that yield doesn't tell you. SHD's 10-year average annual total return is 12.73%, and its dividend growth rate over the last decade, 10.72% per year compounded. That means if you bought SHD 10 years ago, the income it's throwing off now is dramatically higher than the yield suggested at purchase. The yield on your original cost, what investors call yield on cost, keeps climbing every single year while you do nothing. In 2026 alone, SHD is up 13.05% year to date. That's a fund people dismiss as boring. It is not boring. It is compounding quietly while everyone else chases noise. The expense ratio on SHD is 0.06%, 6 cents on every $100 invested per year. For what you're getting, that is essentially free. Now JEPI, the JP Morgan Equity Premium Income ETF, is the income engine of this combination. JEPI currently yields between 8.01% and 8.26%, and it pays monthly, not quarterly. Every single month a distribution hits your account. The way it generates that income is through a covered call overlay on top of a large cap equity portfolio. JP Morgan's team sells options contracts against the holdings, collects premium income, and passes that straight to shareholders. The expense ratio is 0.35%, still very low by active fund standards. Here's the honest trade-off you need to understand about JEPI. Over the last 6 years, its dividend growth rate has actually been negative, down about 3.66% compounded annually. Compare that to SHD's 9.97% dividend growth over the same period. JEPI is not designed to grow its income. It's designed to produce high income right now. SHD builds income over time. JEPI delivers income immediately. Together, they cover both angles, and that's exactly why this pairing works. So how much money do you actually need to hit $6,000 a month? Let's do the math straight. $6,000 a month is $72,000 a year. To hit that with any dividend portfolio, the formula is simple. Divide your target annual income by your portfolio's blended yield. If your portfolio yields 5%, you need $1,440,000. At 6%, you need $1,200,000. At 8%, you need $900,000. A 50-50 split between JEPI and SHD, half in each fund, gives you a blended yield of roughly 5.7%. At that blend, you need approximately $1,263,000 to generate $72,000 a year in income. Now if you want to hit that number faster, and you're comfortable with a slightly higher risk approach, there's an alternative combination worth knowing about. JEPIQ, JP Morgan's Nasdaq Equity Premium Income ETF, currently yields between 10.5% and 11.14%. A 60% JEPIQ, 40% SCHD blend gets you close to an 8% blended yield. At 8%, your target drops to $900,000. That's a $363,000 difference in required capital, which for most people represents years of building time saved. The trade-off with JEPIQ is concentration. It's heavily weighted toward tech and growth names in the Nasdaq. More upside potential, more volatility, less diversification. For someone younger with a longer runway, it's worth considering. For someone closer to actually needing this income, the JEPI SCHD blend is more stable. Here's something almost nobody talks about when they run these numbers, and it will matter more than almost any other decision you make. Where you hold these funds is just as important as which funds you hold. JEPI's distributions are classified largely as ordinary income. That means the IRS treats them exactly like wages. If you're in the 32% bracket, you're paying 32% on every JEPI distribution. If you're in the 37% bracket, it's 37%. That 8% yield on paper shrinks fast once taxes come out of it. CHD is the opposite. Its dividends are qualified dividends, meaning they're taxed at capital gains rates. If your taxable income sits under $47,025 as a single filer in 2026, your federal tax on those SHD dividends is 0%. Even at higher income levels, the rate caps at 15% or 20%. That's a massive difference compared to ordinary income rates. The right structure. Hold JEPI inside a Roth IRA. Inside a Roth, every JEPI distribution comes out completely tax-free. You wipe out the ordinary income problem entirely. Then hold SHD in your taxable brokerage account where the qualified dividend treatment keeps your tax bill as low as legally possible. One structural decision. No change to your investment, no change to your contributions, and you keep tens of thousands of extra dollars over time. Now let's talk about getting there. Because the portfolio doesn't build itself, the most powerful force in this entire strategy isn't the yield, it isn't the expense ratio, it's dividend reinvestment. Here's the proof. If you had dropped $10,000 into a dividend-paying portfolio in 1990 and reinvested every single dividend back into more shares, you'd have roughly $210,000 today. If you pulled those dividends out as cash instead, that same $10,000 grows to about $75,000. The gap between reinvesting and not reinvesting is $135,000. On one initial $10,000 investment. That's what compounding dividends does over time, when you let it run. So during the build phase, before you need the income, reinvest everything. Every distribution from JEPI goes right back in. You're buying more shares, which generates more dividends, which buys more shares. The snowball gets heavier every quarter. The timeline question everyone wants answered: how long does this actually take? Starting from zero with $1,000 a month in contributions, assuming an 8% average annual return, which is conservative given SHD's historical 12.73%, you cross the $1 million mark in approximately 20 years. Push contributions to $2,000 a month, and you hit $1 million in roughly 14 to 15 years. That puts you well within range of the $1,263,000 target for the 50-50 JEPI portfolio. What accelerates the timeline dramatically is starting with a lump sum. If you already have $100,000 invested and you're adding $1,500 a month at 8%, you're crossing $1.2 million in about 15 years. Small adjustments to contribution size or starting capital shave years off the finish line. The key mental shift: you're not saving money. You're buying income. Every dollar you put into this portfolio buys a fraction of $72,000 in annual income. Every contribution feels different when you frame it that way. You're not watching a number climb on a screen. You're buying another $4 per year in permanent income, then $40, then $400, then $4,000. It compounds. Let's get into the actual mechanics of how SHD selects its holdings, because understanding the process builds long-term trust in the fund. SHD doesn't just screen for yield, It filters first for dividend consistency. Companies must have paid dividends for at least 10 consecutive years. Then it screens for cash flow to debt ratio, return on equity, dividend yield, and 5-year dividend growth rate. Only 100 stocks make the cut. What you end up with is a concentrated portfolio of businesses financially strong enough to keep paying and growing dividends through difficult markets. That's why the dividend grew at nearly 10% per year for a decade. The screening process isn't passive in spirit, it's disciplined. JP runs differently. JP Morgan's team manages it actively, selecting defensive, lower volatility large-cap stocks and then writing out-of-the-money call options on the S&P 500 index. The premium collected from those options funds the high monthly distributions. When markets are choppy or flat, covered call strategies tend to outperform. When markets are ripping higher, like the Nasdaq in a strong bull run, JP will lag because the calls cap some of the upside. JP year-to-date in 2026 is up just 2.95%, while SHD is up 13.05%. In a rising market, SHD pulls ahead on total return. In a sideways or volatile market, JP's steady monthly income becomes significantly more valuable. You're not choosing one over the other based on which will perform better next quarter. You're pairing them because they respond differently to different market conditions, and together they smooth out the ride. One more thing before we talk about actually starting this. The number one mistake people make with dividend investing isn't choosing the wrong fund. It's stopping during downturns. In March 2020, SHD dropped about 35% in a matter of weeks. The people who panic sold locked in losses and missed the full recovery, plus all the shares they would have bought at discount prices had they kept contributing. The people who stayed in, kept investing through the drop, and reinvested every dividend during that period came out the other side with significantly more wealth. Volatility during the build phase is not your enemy. It's your most productive buying window. The entire strategy distilled. Put JP in the Roth IRA, SHD in the taxable brokerage, reinvest everything during the accumulation phase, contribute consistently regardless of market conditions, and don't touch the income until you actually need it. When you're ready to flip the switch and start living off the portfolio, turn off dividend reinvestment and let the distributions deposit as cash. 2 tickers, 1 decision. $6,000 a month. Now here's the question that separates the people who actually build this from the people who just watch videos about it. What's your number? Not your goal, your starting point. Because $1.2 million feels enormous if you're starting from zero at 28. It feels completely achievable if you're 35 with $80,000 already invested and a clear contribution plan. The math works the same in both cases. The only variable is time. Tell me in the comments, where are you right now? Starting from zero, already a few years in, or closer to the finish line than you thought? Drop it below. I read every comment and I genuinely want to know where you're at. If this video showed you something you hadn't seen before, hit the like button. It takes half a second, and it tells the algorithm this is worth putting in front of more people. Share it with someone who's still treating their 401k like a savings account and has no idea what qualified dividends even are. They need this more than you do. And make sure you're subscribed, because next week we're getting into something almost no one in the dividend space talks about. The exact order of accounts you should be filling to maximize your after-tax income from this strategy. Get that sequence wrong and you're leaving real money on the table every single year.